private markets are experiencing one of the most dramatic shifts in a while. And for the first time since 2015, more money flowed out of private equity than went in. And so it's interesting to see that there's been huge tailwinds of a lot of investors moving money into private markets. And I think that's going to continue. And we'll talk about that. But what's interesting here is there's something called DPI, which is distributions to paid-in capital. Think of that of every $1 I put into private markets, how much money am I getting out? So it's kind of like a cash-on-cash return for your investments. Now, 2.5 times more LPs rank DPI, which again, distributions to paid-in capital, as the most critical variable when vetting private markets. And this is because there's been a bunch of money going into private markets and not a whole lot of money going out. And we're going to talk through that. What is your gut reaction when you hear something like this?
It tells me the market's growing dramatically. Because I think private equity used to be many years ago, when I started in the business, that was like family offices and billionaires would invest in private equity. You and I wouldn't invest in private equity, or I should say normal people, because we're not billionaires yet. How about that? I'll say we're not billionaires yet. But it was a thing where, billionaire families would invest in private equity. And for a billionaire family, they don't worry about liquidity. They don't worry about getting their money back right away. They worry about long-term growth. And so things like dividends and payouts didn't matter that much. Now, as the market's growing, you have a lot of people. I know you and I are both invested in private equity. Mm-hmm. You have a lot more people invested in private equity. And guess what? More people care about getting their money back and getting dividends and getting payouts than the way it used to be done. So I think part of it is a shift where a lot more people are aware of it and people are investing in it who have different objectives than maybe the families and the billionaires that used to invest primarily 30 years ago.
Yeah, I agree. And we've got a chart here. So chart up, we see the median private equity company hold times. And you can see it's kind of a gradual up and to the right, which just means that the private equity companies are coming in and buying small businesses. And instead of flipping them kind of really every 3 to 4 years, which is what they were doing before, it's now moved to 6 years, 7 years, and even 8 years at the current pace. And so that just means that the private equity company is owning these businesses for longer. But as they're sitting on these businesses, they're funded by all these investors. And so all these investors, all their money's just stuck in that fund, and they need the private equity company to sell out of those underlying businesses so they can return the money back to investors. So it's a big issue. And the question really that a lot of people are asking now is this really just because has the private market been tapped from institutional investors? So when you're thinking of the endowments, the CalPERS, the Yale Endowment, when you're thinking of all these big financial institutions, have they essentially maxed out their allocation to private equity? And so therefore there's not a whole lot of new buyers coming in, and since this is the theory, not a whole lot of new buyers coming in, there's no liquidity on the back end for private equity. And so we'll talk through how I think they're really trying to get into retail, because that could be a new release valve for them. But do you think that's what's happening right now?
That's part of it. I also think, too, things go in cycles. And you have the hot investments that people are excited about. And private equity had so many incredible returns for so many years. Mm-hmm. And now we've had a little pause. Like they haven't been doing as well in the last couple of years as they have for a long time. Yeah. So I think part of it might just be a natural pendulum swing where some investors were over allocated to private equity, or the returns haven't been as good as of late, so that now they're spreading the money in other places. So that always one thing too, when people rebalance, when the wealthiest investors and institutional investors rebalance, they've been rebalancing away from private equity. I think that's part of it too.
Yeah. Yep. All right. Well, next chart, we got a chart up here, investments and exits in the private space. This is from Bain. And really the top right there, funds raised, you can see it actually was down 23% 2023 to 2024, from $523 billion to $401 billion. I think this is a blip. I think that the private markets are going to continue to raise a lot of capital. 2024 was a great year in the stock market, so private markets were competing against the NASDAQ and the S&P 500. If you look back at 22 and some of these years where the market didn't do so well, private markets tend to zig when the public markets zag. So my personal belief here is that there's going to continue to be a lot more money flowing into private markets, and this is just a blip.
Yeah, I'd agree with that. I don't have anything to add.
Well, one thing that could accelerate the injection of capital is President Trump signed an executive order, and he's really demanding the Department of Labor and the SEC to provide implementation guidelines on how ERISA plans, which are 401ks, can start investing in these private markets. And right now, the big issue is from the SEC's perspective, there's a 15% cap on illiquid holdings that mutual funds can have. And also a lot of the plan sponsors. So if you're a company, and we're a company, we've got a 401k,
Yep.
we don't want to get sued by our employees. And how do you get sued by your employees is if you put really expensive funds in the 401k, you're not acting as a 338 fiduciary, they can sue you. And there's a lot of lawsuits going on. Intel notably was subject of a huge class action lawsuit there. And so there's a lot of, that's why there hasn't been a whole lot of private markets in these 401ks, because it's generally a higher cost investment vehicle, illiquidity, there's all these different issues. And President Trump essentially signed an executive order trying to eliminate or reduce those barriers.
And just to be clear, did you start the class action lawsuit against Intel?
I did not.
Okay, because I know you worked for Intel.
I did not participate. And
Many years ago.
back when I worked there, we were actually Fortune 50, or they were, and now they're just a relic of the past.
Yeah, well, once you left, I think that was the beginning of the end for Intel. A lot of people don't know that. That's a little secret, that when Bryce Keffeler left, that was the end of Intel. It's interesting. I think that it's overblown with some of the media stuff with this thing with 401ks, because just like you mentioned, 401k providers and business owners, there's people who have fiduciary responsibilities for the employees. And I don't know anyone who has fiduciary responsibility who would want, someone who's putting $1,000 a month into their 401k, who's uneducated about investments, to be having some of their money go into private equity. So I think it's going to be a slow move, and they're going to have to get people in the 401k markets, like some of the big providers, as well as some understanding about ERISA laws and how those apply, because ERISA laws are like the IRS. They're very powerful. Yeah. So I think there's going to be reluctance to make that available for people who have 401ks. But I do think in the retail expansion, people are they're learning more and more about this. We talk a lot about this with our clients, that we didn't talk about this stuff 15 years ago, that we're talking about this all the time. My good friend Bob Fraser just came out with a book, Invest Like a Billionaire. He talks about it in there. Tony Robbins came out with a book, The Holy Grail of Investing, I think was the name of it.
Great book,
where he talked about private equity and all these different, private credit and venture capital and the stuff that really only the wealthiest people and the largest institutions invested in. And now this is becoming common knowledge. I think a bigger opening of the floodgate would be if they somehow relax some of the accredited investor rules. Because that's been talked about a little bit too. Yeah. And the argument is, why should someone, just because they're not making, $200,000 a year for 2 out of the last 3 years or something like that? Yeah. And $1 million net worth, not including your home, whatever the numbers are, those eliminate a lot of people from being able to invest in private equity, no matter how smart they are, no matter how savvy they are. And is that fair? So there's been some talk. If they relax the accredited investor rules, then I think you would see massive inflows to private equity, because you've got a lot of people who've only had access to public markets. And just the way we've seen money move to crypto when that became available. And by the way, I think crypto doesn't have any limitations with who can invest in it. So why should private equity be so rigid about who can invest in it? Now, obviously, I think people got to be smart and not be dumb. And the money has lockup periods and all these kinds of things. But I think people should be able to invest in things more than just public equities and public bonds.
Yeah, the education is going to be the difficult piece. And how do you educate if you reduce those barriers for the accredited investors? The theory being, hey, you're sophisticated because you make a lot of money or you have a balance sheet, therefore you know what's going on. But it also leads to, well, how can I become wealthy or sophisticated if I don't have access? So it's a catch-22.
And if you think about it, people buying individual stocks, I've known a lot of people who've lost their blank trying to day trade, right? Remember, day trading was this big hot thing, like when the internet was first coming out. And you can day trade and not be an accredited investor, but you can't invest in private equity if you're not an accredited investor. So that, to me, seems right. You can do dumb stuff with your money. There's no, what do they say, that the difference between genius and stupidity is there's a limit to genius.
Okay, that's a new one for me. I like it. Well, why this matters? So the market opportunity, this really would double the TAM. There's about $12.5 trillion in 401k assets. Right now, according to McKinsey, in 2023, the entire private market AUM was $13 trillion. So if you allow these guys to sell through or sell into this channel, it doubles their TAM. And then can we start seeing a reduction in the whole time of private equity, because now there's all this new cash potentially coming in. So it'll be interesting to see the developments here. And I know just recently, T. Rowe Price is now doing a partnership with Goldman Sachs. T. Rowe Price has distribution into these qualified plans. Goldman Sachs has access to private, deals and markets. So it'll be interesting to see if that's a marriage that potentially is, laying the groundwork for expansion in here.
It's going to be interesting to watch.
Yeah. Well, why would you want to invest in private markets? And really the big reason, and we go to the next chart here, is going to be historical outperformance. So this chart just shows the global private equity net return versus the stock market net return. That's the gold bar there. And really what this shows is over the last, let's call it 30 years, private equity's done 15.6% annualized versus the stock market doing 8% annualized. And so the idea being that you're accepting this illiquidity, you're accepting your money getting tied up for what was 3 or 4 years, now closer to 7 or 8 years, but you're going to outperform. And over the long term, that's held true. But if you look on the left-hand side of that exact same chart, it's really that gap has shrank. Because now if you look over the last 5 years, private markets have done 15% per year, global stock market 13% per year. So only a 2% spread. So curious to see, do you think the private markets are going to continue to outperform the publicly traded markets longer term?
Boy, I wish I was smart enough to know the answer to that question. But I will say that when we just look at fundamentals of finance, which, it's easy to look at trends and people try to guess the future, but usually things come back to fundamentals. Mm-hmm. And fundamentally speaking, private equity should outperform global stocks. And the reason why I say that is private equity there's illiquidity. You can't get your money out right away. Whenever there's an investment that's illiquid, it should perform better than an investment that's liquid, all things being equal. And so there's things about private equity that inherently should make it outperform. It's also the reason why you want to not just have all your money in private equity.
Right.
That's why you want to be diversified. And so stocks and bonds have their place, private equity has its place, venture capital, private credit, all those things have its place as you grow your balance sheet and your wealth. And for entrepreneurs especially, because entrepreneurs are the ones who can get seriously wealthy in this country, having that diverse portfolio, and I know entrepreneurs, and you and I both know, who they're like, I only want to invest in real estate and Bitcoin or something like that. It's like, and they don't feel comfortable with things like traditional stocks. And I say, you should own all of that stuff, right? Because the question is, are you trying to get rich or are you trying to stay rich? If you're trying to get rich, your business is your best avenue to get rich, being concentrated in that investment. But once you have a liquidity event or you peel enough money out of your business to build a balance sheet, then you want to stay rich. And to stay rich, no billionaire has all their money in one thing or one category. They've got it spread around. And every entrepreneur, once they get to a certain level of wealth, they should spread it around too. So a long way to answer your question. Over a long period of time, I think private equity will outperform global stocks, but it doesn't mean that people should ignore global stocks because that should be a part of your portfolio too. And there will be times when global stocks outperform private equity. That's just natural.
Yep.